Hi everyone, I'm Noah Lichteinstein from Cowboy Ventures, and I'm here to talk about the value proposition. First, I want to quickly thank Chad for including me in this. I actually met Chad about 10 years ago when I was an aspiring lawyer at a previous law firm we both worked for. He was hosting similar events to this, and when I had the idea to kind of go into the entrepreneurial side, I attended similar events to this. So it's really cool to see this still going on. It's got so much bigger and better. Quick note, we're going to send out the deck later. I have to pull a couple things out of this that are a little sensitive, but I want to show you some other information. And then also want this to be interactive, so I will have question time at the end, but if you have anything burning or thoughts that come up, please just jump in and let me know. This is your time, so I want to make it easy to make the best use of it. And also, if I stumble around into this, it's my first time doing this actual presentation, so I'm sure I'll be some bugs. All right, so quick background. So I'm a partner at Cowboy Ventures. We're a seed stage fund that was started in 2012. We have a $40 million fund, which includes two partners, my partner Aileen on the left there and myself. We have 6 ninjas, or actually what we consider special advisors. These are people who have day jobs, but they dedicate time every month to spend with our entrepreneurs to help in their areas of expertise, whether it's growth, technology, marketing, data science. Other things that early stage companies don't have a full-time staff member dedicated to, but can use those resources. And then our mission is really to back these most beloved companies in consumer enterprise, focused on what we call Life 2.0, which is how does technology help us reimagine our personal and professional lives. I'm trying to move through this stuff pretty quick. We've done 17 kind of core investments to date. We look at ourselves as an anchor investor in the seed stage. So we're typically writing one of the larger checks, if not the lead, and then rounds are filled out with some kind of angels from there. And if you have questions at the end, more specifics about the fundraise structure, I'm happy to go into those. But we're about 60% consumer and about 40% B2B. We stay away from the deep infrastructure stuff that we don't know much about. Okay. Also worth noting, most of those you probably haven't heard of, because in the seed stage, as I'm sure some of the companies here, many are in stealth, many haven't launched publicly yet. Some are still just pre-product. My brief bio. So I started out growing up on a farm in Oregon, went down to Stanford University, thought I was going to go into politics or law, where I met Chad at another law firm. Got sidetracked when I had an idea at that law firm for a company. Something was happening at the law firm I thought could have been done better. And so I went out and said, I think we could actually do better. Not with the law firm itself, but with some of the operations. And then after that, I went to a company early on called Weatherbill, which became the Climate Corp. Some may recognize that in a nice $1 billion exit a few months ago by Monsanto, and raised quite a bit of money in that process. And then I was one of the founders of Home Run, which was in the daily deal, local deal space. If you all remember that kind of crazy heat around Groupon, Living Social, we were one of the fortunate ones to really build a great differentiated product and get a nice little exit about 18 months into it. And now I've joined up with, as I said, my partner Aileen, and we're on the other side. So one of the things that I really valued as an entrepreneur was having investors who had done it before and kind of had some street cred, or speaking from experience, not just sitting in an ivory tower. And for my part, I hope that I can bring some of that to my investing. So what we're going to cover today, value proposition. Let's make sure I'm actually checking my notes. All right, so before we dive into what the value proposition is to investors, I think it's also important to distinguish the difference between your core value proposition as a company, what it is that you're actually providing, what benefit it is, and then what is that value to investors, and what is it that investors are looking for. And then why is that important? Well, if it's not clear that there's a problem that you're solving and that it's really meeting a need, then you really shouldn't be meeting with an investor in the first place. All right, so more about that in a minute. So let's start with the company value proposition. What is the purpose of the value proposition? Well, the purpose of it is to help inform the customer so that they can make a decision. So whether or not it is your customer is an individual with a consumer product or another business as a SaaS company, ultimately you need to help get the customer to pay for your service or to download your service. And so you need to have a value proposition that helps them inform that decision. All right. So, what is the value proposition? Well, there's actually been a lot written about this, some really great readings that you can find, one that I thought had done a really good job with was Michael here at Orrick Venture Partners, so I decided to borrow it from him. But the value proposition is a positioning statement that explains what benefit you will provide, for who, and how you will do it uniquely. Or uniquely well, I should say. You don't want to do it uniquely poorly. And then what is the value proposition not? It's not a mission statement for your company. It's not your company vision. It's also not your elevator pitch. But this is really the what, the who, and the how of your business. So another way you can put it is, what is the problem that you're solving, or what is the benefit that you're providing? The who is, who are you actually solving this for? Again, who is your customer? And the how is, how are you going to plan to solve this problem? How does your product or service solve this in a new and different way? And another preface I just want to kind of make is that companies that have a high value proposition typically will be able to raise money, in my experience. So it's the companies that feel like they have to do some sort of fundraising jujitsu or to put some lipstick on a pig or whatever it is, those are the companies that really struggle. And so ultimately I think that if you don't find yourself having a really strong value proposition, the who, how, and what are not really strong, you should probably kind of look yourself in the mirror and take a step back and say, let's make sure I nail that first before I go out and start wasting a lot of my time, my time being your time, to go out trying to raise money, and it's going to be pretty hard. All right, so I thought it'd be good to start off with a couple examples of value propositions. Quick disclaimer, these are not official value propositions from them. I just kind of took a minute to write them out. So Uber, I assume most of you know what Uber is. But if we break this down, Uber provides an on-demand personal transportation through a simple mobile application that enables users to request, ride, and pay for transportation at the push of a single button. Unlike with taxis, passengers get reliable pickups, clear pricing, and convenient cashless transactions. So if you break that out into the what, the who, and the how, and by the way, I should preface this, it's a marketplace, so this is the value proposition for the consumer. There'd be a different value proposition for the drivers. So the who here is, it's passengers, people who need personal transportation. The what is the problem that it's solving. That taxis are unreliable, you don't get clear pricing, and it's not as convenient, and it's not cashless. So that's the what. The how is they do it through a simple mobile application. So nice and simple. I think I got that pretty close. One more example, Dropbox. Another one, use a couple companies people might recognize. So it enables users to store and access their photos, documents, videos, any files, anywhere and share them easily. Unlike local storage solutions, it does this by storing digital copies of these files in the cloud and automatically synchronizing them across the user's multiple devices. So again, it describes who the target buyer is, the who, which is anybody who wrote the files, the problem that it solves, which is the what, which is, that's not unrealistic, it's just a little bit wrong slide. The problem that it solves, which is being able to access your documents anywhere and to synchronize them. And then the how it does this is by syncing them in the cloud across multiple services. All right. So once again, let's dive into each of these three components. I know I keep hammering this, but the what, who, and how really is the bread and butter of what your value proposition is. All right, so the what. What is the specific problem that you're solving? So you want to start by defining what that problem is. You can't hit a bullseye without a target. Similarly, you can't build a great product or business if you don't know what it is that you're building for. And you want to make sure that you're also not just defining the problem, but you also want to make sure that you're validating it. So a common mistake I see from a lot of entrepreneurs is they say, I have this great idea, this great technology, I'm going to go out and build a business. But they haven't taken the first steps to validate that this is actually a problem that people have, or that it's a big enough problem that enough people have. So you want to make sure that people actually view this as a problem. There's different ways you can do this. You can do a survey, you can do focus groups, you can build a very basic prototype and launch it and get feedback. As mentioned earlier, you can launch a startup or an idea much cheaper, especially if it's a consumer app. You can launch it very quickly and get feedback. Enterprise is a little bit different story. And then how big is the problem? You want also, in addition to defining the problem and validating it, you also want to be able to measure how big is this. Is there a substantially big enough market, big enough problem that warrants going out and building this? And we'll talk a little bit more about that in what investors look for, and this kind of feeds directly into the total addressable market. But I think also you want to address the sort of the who cares. So is this an urgent problem for somebody? Is it a slight improvement on an existing process, or is it a really big game-changing process? Is it really going to revolutionize the way someone conducts their business? So the bigger the problem, the more urgent it is, the higher your value proposition is going to be. And I think for anyone who's ever done sales, it's very similar. You have to, the more urgent it is, if it's a critical thing that's broken, you're going to get the attention of the decision makers much more quickly than something that's just incremental or slightly better. So let's talk about the who. So you want to make sure you understand who your customer is. Oh, sorry. Hi.
I disagree with that last statement.
Sure.
You're not going to get their attention with I agree. Most people just take incremental change.
I'm sorry.
Getting somebody to take big transformational change is not difficult. And you just made a statement on understood.
Okay. So the question was that, or the challenge to my assumption was that if the incremental change actually does matter, and that, if I get this right, the incremental change is actually sort of better than a big, step function change. Because a step function change might scare them off or not be. Is that what you're saying? Am I capturing your question? So the question was, or the challenge to the statement was?
You said that you're going to get their attention
Yep.
if it's great. And I disagree with that.
Okay.
Because most of the changes that people have been implementing for years and years and years are incremental. Very, very few.
I think it's all that varies in how you define it. I think that it's very rare to actually care as an investor or for even a consumer to really care if it's just a slightly meaningful difference. If Uber came out and said, we're going to actually take taxis and we're going to put air fresheners in all of them. It's an incremental improvement, but is that really going to solve all the problems? So I think it's a variation. I don't think there's a black and white answer, but I think it can't be such a step function that is totally foreign, but it has to be a meaningful enough change. Otherwise, why are people going to pay attention and change their routines? People are inherently opposed to change unless it's clear that it's an improvement. But I take it. So the who. So again, identifying who it is that will benefit from your product or service, and why does that specific group care? And this is for the company value proposition, but also for investors. We'll get more to this later. You want to be able to paint a picture for the investors of who is this core user. Is it a individual or is it a business? Is it a male or a female? Is it somebody who has files they need to store? You can define and segment your customer in any way, but you have to know and have an image in your mind of who is my ideal target customer. And from there, that'll help with guiding product, but also help in conveying the message of your business and the value proposition. And then the how many are there? That's again part of this defining who they are, validating, do they really care, have you done any testing, any sort of surveys to make sure people actually care about this. And then on the measuring, making sure that there are enough of this segment to warrant building a really big business. And this will tie into the total addressable market, which I'll come to later, which investors care about. Yeah, hi.
Good question. If your business is connecting two entities within an industry, one entity is the paying entity who's going to generate revenue for you. The second entity is a larger user base that are going to benefit from the services that are being provided. Does that explain okay?
But if you say it one more time, I'm sorry.
Yeah, the second entity is kind of your larger user base who's going to benefit from the product that you created connecting these two.
Sure.
Is the customer the first or the second or both?
I'm not sure I quite follow the question, but I think maybe if I put it another way, I think on a consumer side, business is understanding, if it's women, parents, because it's a company targeting, baby products, it's important to know how many there are in this, and if you have a price point for that product in mind, how many have the income levels that can actually support that. Those are the kind of data points. On a SaaS side, You want to understand what is that target group. Are you targeting businesses with under 5 million in revenue, or 5 to 10, or 10 to 20? Are these companies that are in pharma, or are these companies that are in specific verticals? So just identify however you want to slice and dice it. There's no right way. There's just a way that you can convey to yourself or validate for yourself, but then convey to investors that there is a large market there. Yeah, you're welcome. And then lastly, from the who, what, and how, the how. So you want to explain what your unique solution to the problem is. You want to make sure you address what other existing solutions there are to the problem. And you also want to explain why is this better than the existing alternatives. So some of these reasons could be, is it a price-based thing? If you've done something much cheaper, you're going to win on price. Could it be something that's an improvement, to your question, an improvement on an existing product or service, but that's incremental and meaningful to people? Or is it an entirely new innovation? Is it a whole new market that you're creating? You know, I think that you look back to examples like Twitter. You know, what was the real value proposition for Twitter early on? Well, there weren't a lot of people raising their hands saying, I really need to be able to express myself in only 140 characters. But they created a whole new market, a whole new medium, and looked around the corner. So I should preface all this by saying none of this is, you know, hard and fast boundaries, just sort of a framework for thinking about your business. All right, so just a quick recap. The company value proposition is the what, who, and how of your company that helps inform the customer so that he or she can make a choice. And I think, again, it's really important that you absolutely nail down the value proposition of your company to your target customer before you ever consider going out and raising money. You got to make sure you understand that. If there's not a good product or problem to be solving, you really should make sure you're focused on finding that right problem and that right solution before you go and try to raise capital. All right, good on the company value proposition for now? All right, cool. We'll have some more time for questions at the end. All right, so let's talk a little bit about the investor value proposition. And I thought it'd be good to preface this by giving a little bit of background. You know, one of the things that when I moved over to the venture side, from the entrepreneurship side, there's a lot of kind of mysterious things that I just didn't know. There's a lot of stuff written now, but I want to go through a couple of them. So the question I oftentimes ask entrepreneurs is, well, what keeps you up at night? What are the things that you're really kind of focused on? But I think it's important to think about for VC is what keeps us up at night. Well, a lot of people don't realize this, but you know, well, take a step back. The goal of a VC is very simple. It's to deliver top-tier returns to our investors. So we have investors that we report to, much like entrepreneurs who raise capital have investors. If we're not able to deliver top-tier returns to our investors, then you know, we're out of a job. So that's sort of the framework that we have. It's not a bunch of kind of wealthy people with their money who just kind of sit in an ivory tower. And you know, these are people who actually have to deliver and should be aligned with your incentives to be successful. If you're successful, they're successful. So one of these is important to know that returns are most important, but all the other things like giving support to our entrepreneurs, being part of the community, trying to speak at events, trying to meet with a lot of people, open doors, all of that is stuff that we want to do, but it feeds the goal of making sure that we're generating good deal flow, doing goodwill, able to deliver good returns. Needles in the growing haystack, as was mentioned earlier, it's now cheaper than ever to be able to start a company. You now can basically get a company up and running on AWS, especially on the consumer side. It doesn't cost millions and millions of dollars to get your company off the ground and to start validating. So with that, you've got more and more companies being started every year. There's also more capital available at the angel level. And so there are just, the volume of deals that venture capitalists see now is pretty astounding, and the odds are pretty difficult. And I just give this as sort of context because sometimes investors can seem like they're aloof or ignoring you or whatever, but I think it's important to understand the context. So Aileen and I, just the two of us, in the past years saw about 1,000 deals. And that's between kind of two people aside from supporting our entire, our companies. We funded 17 of those. So basically that means that 98% of the deals that we see, we're not able to invest in. So that's kind of ties into the next point, which is it's not personal. It's simply that there targets a law of numbers. There's other factors also that go on that I think you should be aware of. And these are things you can feed into your research before you go and decide which investor you should meet with. Things like, what are the size checks that these firms write? And how many checks are they going to write across the life of their fund? If you're only going to write 10 checks, it's going to be a higher odds than somebody who's maybe going to write 50 checks that are small. So understand that. And then the other thing is there's other factors that I also wasn't aware of before I moved to the investor side. Things like capital calls. So if we just made 3 investments in a row and had to call the capital from our investors and say, hey guys, that money you said you were giving us, we have to take that from you now so we can invest it. If we just made 3 investments, it's going to be pretty hard to go and make another large investment the next week. So timing actually does matter. We can't go and make 10 investments all at once. We actually do need to course them out a little bit. Another thing to consider is sometimes around portfolio diversity. So if we're making kind of a bet on a new technology or a new kind of interface, we may not want to overload or index too heavily on that. We might want to see how that goes first. So sometimes it depends on what you've already invested in, what you're looking for. There's a lot of factors. Bottom line is, don't take it personally. Lastly, I want to emphasize this one. There is no right investor. There's just the right investor for you. I think a lot of times in this echo chamber in Silicon Valley, you've got the brand name firms or you've got angels who have great brand names. I think that's great. But I think it's important to think about that this is going to be your partner. The person who invests in your company is going to be with you. If you're building a big company, they're going to be with you for 6 to 10 years. The average time that it takes to get from starting a company to liquidity for billion-dollar companies is 7 years. And so just realize that this is someone that you want to have who's going to be there through the highs and the lows, who's going to be your partner, who's going to believe in you. And I think it matters a lot less whether or not they're that brand name. I've seen plenty of, or experienced plenty of times, the brand names you don't have the time for. So just a little bit of, or a lot of, I guess, preface. So what do investors care about? Let's cover the 4 kind of core things that investors care the most about. And again, I should preface this by saying this doesn't maybe apply to everybody. This is just the way that we think about it. So the 4 things: the team, the market, the plan, and traction. And if you don't have traction at the early stage, maybe some proof you can rock it. So let's go through each of these in a bit more detail. So the team. The team is really the horse that you're betting on for this race. And again, it's going to be a long one. And so I think that as an investor, especially at the early stage, we know that a lot of things are going to change. You have a core thesis, we don't expect you, or we don't want to invest in companies that are going to be wishy-washy and move kind of side to side. But we do know that oftentimes you have a core thesis, things are going to change. There might be some, you might have some experiences where employees take off. You get some IP litigation, there's product doesn't work. There's a lot of things that are going to happen as you get bumps in the road. The team is what's going to drive you through. So that's really the most important thing, kind of in my book. I know some people think idea, or I think it's a quote. If someone has the horse and jockey, I generally tend to go for the jockey. So then the makeup of the team. I think it's important when I look at a team coming into pitch, what are the skills that they have and what is the background? And then also, is it one person or is it multiple? So there's nothing wrong with being a sole founder. There have been plenty of great examples of sole founders, but in my experience, I tend to really lean toward teams of multiple people who complement each other's skill sets. I think that starting a company is hard enough, and having a couple of heads there, people who counterbalance one another can be really helpful. Yes?
Advisors.
Yes. No.
The makeup of your advisory team, does that have any, and what they bring to the table, is that taken into consideration when you're looking at teams?
This is just for me personally. I tend to kind of discredit advisors unless they are really uniquely meaningful for your company.
Can you repeat the question?
Yeah, I'm sorry. Yeah. The question was, how do investors look at advisors in the context of a team? And the answer I was giving is, I think that if they're really strategic to what your business is doing, then I think it can be an advantage. But ultimately, the advisors are not going to be building your company. And so it's not as important. I think the more generic and general a business advisor is, the less valuable they are. But if you're doing something very specific, and that person is an expert in that field and has done it before, I think it is definitely an advantage.
Okay.
But it's definitely secondary to the core team. Who's building the product.
Thank you.
You're welcome. So a typical team structure that I'll look at is often you want to have someone who's the sort of product visionary, has the idea of like, where is this going? What is the big opportunity here? What's the massive vision that we're going after? And then you have the technologist, the unique person who can go out there and build this and actually execute on this. And so that's a typical team. I would say that as a business person who's not technical, I do get wary when I see two business people that are starting a company together on a problem that is uniquely technical. So I think that you just need to make sure, or as an investor, what I look for is do the skill sets, do the background, match what the problem that these entrepreneurs are trying to solve. And what's that unfair advantage? So is it technology? Is this the best coder in the world who is going to build the absolute best product? Or does the product leader have some sort of unique insight? They were at a company, they saw some unique knowledge that other people in the public aren't aware of or they're not seeing. So what's that unfair advantage? And lastly, I'd say the intangibles. So what's that kind of special X factor that individual is going to help really take it to the next level, separate a strong company from a unicorn? Are they a leader? Are they going to be able to recruit well? These are all things that we look for, and when they're challenged, are they going to be able to stand up to that challenge? All right. So the market. Don't want to. I know this was touched on earlier, but I'm going to encourage on the first bullet point here to really think big. One of the problems I see most is people thinking too small. Now, I'll add a caveat that it depends on who your audience is for an investor. So for me as a seed investor, we're looking to invest in large companies. The way the portfolio works is not every one of our companies is going to make it, sadly, but we're going to get our returns on those few that are the home runs that get massive returns. And so we really need to be looking at companies that are in large enough markets that if they're successful, they're able to become billion-dollar companies. Well, I should say we actually don't need to invest in billion-dollar companies as a smaller fund, but the larger venture capital firms really do need to look at those companies that can be billion-dollar companies. And so let's look actually at the math a little bit on that. So when I say that it needs to be a billion-dollar company or a billion-dollar market or a $10 billion market, I know that sounds like a lot of money, but if you peel back the onion a little bit, look at the math. Let's say you're building a SaaS company, and you want that SaaS company to be the next member of the billion-dollar unicorn club. So if that market size is, let's say, where are we at here? I did the math, so I didn't have to do it before. But say you're in a $200 million market. If you need to get $50 million or more in your annual recurring revenues in order to be considered a billion-dollar company, I think the marker is maybe $100 million in annual recurring revenue to do that. And you're looking at having to, yes, 5 minutes. Okay, they have a question. Then you're looking at having to capture 50% of that market just to be able to get to that $1 billion. Whereas if you're in a $10 billion marketplace, you can only capture 1% and still be able to build a really big business. So large market, room for innovation, room for other competitors. Competition's a good thing generally. So think bigger. I need to speed up. So addressable versus total market size. So you want to have a large total market, but yeah.
Clarification on that last point.
Yeah.
So 100 million in recurring revenue would be considered a $1 billion company?
It varies, but if you look at traditional SaaS companies, 100 million in recurring sort of translates into the $1 billion valuation. We have seen some companies go public with lower than that lately. Addressable versus total. So someone comes in and says, you know, that they're in I don't know, use an example, that we're in the transportation space. Well, transportation is a $1 trillion industry. Of course it's massive, but is Uber really going after the entire transportation space when they're pitching their seed investors? No, they're going after personal transportation. So what's the actual addressable subset of that market? It's okay to say that once we get going and we get some of that captured, we can go to the bigger market, but really make sure that initial market is big enough as well. And make sure it's also a growing market. Yellow Pages is a huge industry, huge market still. But I think to be pretty clear to all of us that the Yellow Pages are shrinking, whereas many other kind of industries are fast growing. You want to be on the growing side of that trend. And then comparable exits, strong multipliers. It's kind of useful to look at in a market. Are there other good markups happening in that market? Yes?
So if there aren't any comparable exits at like where we're at because it's an early stage market, can you use comparable fundings
Yeah, I think it's anytime you can pull data that actually supports what you're doing, I think that's useful. All right, I need to actually speed up a little bit here. So the second to last one is the plan. So the plan is made up of product roadmap, your metrics and milestones, financials and projections, and the hiring plan. So one of the things we look for is that product roadmap. We know what it is that you're going to be building, but you need to be able to outline, okay, with the resources that we have and with this idea, how are we going to actually go out and execute on it? So oftentimes it's great when you see kind of the product lead have a Gantt chart that says, okay, here's the sequencing of the different features that we're going to release, here's how we're going to do it, here's how long our product life cycles are, our development cycles are. Having that plan and roadmap in place is really key so that we know how you're thinking about actually building the company, not just having the idea. Metrics and milestones. So we're personally, my partner and I, we're both very data driven. So if you have data, we want to see that data. How much is it going to cost for you to acquire a customer? What's the lifetime value of that customer? What are the weekly, what are the WAUs, what are the MAUs, what are those different metrics going to be? And if you don't have data yet because you're early stage, that's fine, but be able to speak to the metrics that are going to be important to you. So just that you're thinking about it in the right framework so that when we do launch this, these are the metrics that are most important, and these are the milestones we believe we need to hit. That tells us that you're thinking about, you understand the opportunity and how you're going to get there. Financials and projections, similarly, it's less about making sure your financial plan is right at the early stage. I can guarantee you your projections in the early stage are going to be wrong, but the way that you're thinking about it tells us a lot. Are you going to see your revenues jumping from 5 million to 100 million within a year? That's telling me you're not really thinking that wisely about it or realistically. And then hiring plan, just understanding who are the bodies that you need to hire in order to execute on that plan. All three of these things, the product roadmap, the metrics, the financial hiring plan, all four of those actually kind of feed into one another. They should all be able to look at one and say, okay, you're going to deliver this product at this time. Let's make sure you have the right hiring and headcount to get there, and that your financials actually account for hiring that person. It should all tie in nicely together. And lastly, traction or some proof you can rock it. So traction, if you have data points, that's awesome. Show it, provide it to your investors. If not, other proof points, similar companies that have done similar things or parallels that have been able to. And, all right, so, Joyce, come in. All right, I'll keep going. All right, so lastly, I wanted to kind of talk a little about what to expect before, during, and after a meeting with investors. So before, really important to do your homework. Before you even reach out to an investor, make sure that they're the right investor for you. If your company is doing, dog photo sharing for, consumers, don't go talk to an investor who only did invest in SaaS. Just don't waste your time, don't waste theirs. Make sure you know why you're talking to this investor. Reaching investors. This may sound a little elitist, but you need to have a warm intro. You need to have a warm intro to that investor. If I get so many, my partner and I, we see 1,000 deals, and that doesn't include everything that we've actually taken a look at. It's just hard to separate all of that flow. And so what I look for is the intros from people that I know. And yeah.
What are your criteria for going for warm intros to setting up? We've actually had some issues with that.
Sure.
Yeah.
So the question is, what's the criteria for moving from a warm intro to taking a meeting? So let me answer that in the context of wrapping up that thought, which is the reason why I think it's so important to get a warm intro is, as an investor, it tells me that if you don't have kind of the hustle, the scrappiness to find a way to find that connection between us. I'm a pretty social person. I go out and do a lot of different things. If you don't have that scrappiness, how are you going to go out and get a new product out to these customers who don't know you from Adam? So there are exceptions to this, but if you don't know me, then find a way to go out and find events that I go to or other people that we've invested in and get to know them and get a meeting through them. There is always a way. But to your question, I think that there's really no right answer. I think that warm intros help, but you have to keep in mind that with the amount of deal flow investors see at the seed stage, we have also different people that refer deals that we kind of put higher priority than others. So, we do a lot of deals with our friends at First Round or our friends at the SoftTech or other different great firms. When they send us an email, it's going to go to the top of the list, whereas somebody that I met 3 years ago at a cocktail party, I'm not going kind of how it works. During, I'm going to fly through this. The goal of the first meeting is not to get a check, it's to get a second meeting. Make sure you're piquing their interest. And you really want to start strong. You really have that first 30 seconds or maybe a minute and a half to really grasp that interest before the investor kind of starts making initial judgments already. And so you want to be compelling. Why are you a compelling entrepreneur for this? And this is where the sort of elevator pitch will come in that was referred to earlier. Being able to quickly, concisely, in 30 seconds, being able to convey, what it is that you're doing, who you are, why the investor should care. And that's why having a value proposition for your company totally nailed and buttoned up is so important. You have to know the who, what, and why of this product and why you're doing this, why people care about this, so you can quickly and crisply convey that to the investor and grab their attention. The other one's kind of self-explanatory, but yeah.
Super quick question, Matt. When do you suggest getting to a demo, like show, don't tell?
Yeah, sorry. So great point. If you have a demo of your product, always show when you can, instead of telling. I think it's really great to, if you have something that an investor can play with, if it's an app, if it's a SaaS product, you can show and demo. If you have the investor actually interact and play with the product, it creates a closer connection and they can experience it. And I just think that why would you go through the effort of building something you're not going to actually let them use?
Do you lead up to it in your pitch or you kind of get to it too quickly?
I think you want to first start strong, get that hook, make sure that you make a compelling case for kind of who you are, why you're doing this, what you're doing, and then you have kind of 10, 12 slides or whatever it is after that to actually go into the product roadmap, all the other things, and the product itself. After, make sure you send a follow-up note thanking the investors for their time, but also you want to re-summarize what those next steps are, what the action items are. And then I'm going to actually stop here on the investor process.
Yeah, so the goal of the first meeting is to get a second meeting?
Yes, sir.
What's the goal of the second meeting?
Get a third meeting. No, it depends on, it's actually a great question. What's the goal of the second meeting? It depends on the investor you're talking to and what their process is. This is the last kind of thing I'll cover because I know I'm over time. So it depends on the firm. So with us, with Cowboy, it's just Aileen and I. Everything we look at, if I see something that I like, I'm going to go and say, hey, I really like this Aileen, you need to meet with them, and we'll set up that next meeting. She'll meet, and then based on kind of the company, if it's something we're really familiar with, we know inside and out, we can get to a decision quickly. If it's something that we actually need to know more about, maybe it's a bit more technical, we might need to bring in, one of our kind of more technical advisors to do a diligence call. So there's no one right answer, but depending on your company and the specific investors, the process is going to change. If you're talking to someone at a larger firm, they may have 5, 6 partners, and they have to go through a process where a certain number of partners all meet with it, then they have a partner meeting, they all vote on it. So I think that's a question you should ask in the meeting with an investor. What is your process? Thanks. All right, so there's a couple of things. We'll have the deck sent out, yeah, that's it. Thank you.